Hey, it's Stuart. I've been asked to compare VDHG, which is Vanguard's Diversified High Growth ETF, with GHHF, which is Betashares' Diversified ETF with about 30 to 40% of gearing. If you look at the asset allocation with Vanguard, it has 10% in fixed interest, whereas Betashares doesn't have any fixed interest exposure. And Vanguard has some exposure to smaller companies that Betashares doesn't have. Betashares has exposure to the Australian market, international and emerging markets, as does Vanguard. But the asset allocation differences aren't that material, I don't think, and I don't think it's going to have a huge impact on future returns. So the difference between those two products is gearing versus no gearing. And I guess the question is, when should I choose a geared ETF versus an ungeared ETF? Well, gearing will increase the volatility of the product because, of course, it magnifies returns, both positive and negative. Gearing works fantastically well if you have a very long-term time horizon. If you have a much shorter time horizon, then you probably shouldn't add gearing to your investment strategy. So in my view, if you wanted to invest progressively in a diversified ETF and your plan was to do that for 10 plus years and you think the probability of needing to interrupt that strategy and sell those investments is very, very low, then the geared ETF is probably your best option. It's probably going to maximize your returns, noting that there is going to have higher volatility, but from point to point, say over a 10 or 20-year period, it should generate the highest returns. So I would go with GHHF. If you weren't confident that you could have a 10 plus year time horizon, then it's probably best not to add gearing and just use VDHG. Hope that answers your question. It's a really good one. Thanks so much.